Is there any optimism that we can take from all of this conversation? Not really, is there?
Not really. No, to me, it's so effectively growth has become a dirty word. I call it economic vandalism in terms of what they're doing. They're putting Australia back 50 years or even 300 years before Cook arrived. To me, it's crazy. It's either gross incompetence or ideology. To me, or they are just grossly stupid.
Yeah.
Yeah, it is naive. It's economics. It's first year economic.
My guest today is Geoff Wilson, who founded Wilson Asset Management in 1997 and now runs about 6 billion Australian dollars for 130,000 investors. He has spent the past decade fighting 3 separate tax fights with Australia's Labor government, and he is in the middle of a 4th. If you're watching from outside Australia, this will look familiar. The argument here is the one being had everywhere. It's about whether taxing capital is the way to fix inequality. Geoff, welcome. Hi, Geoff.
Hi, Claire.
There seems to be an assumption in our political class at the moment that if someone is getting richer, someone else must be getting poorer, and that wealth in this country is fixed, a fixed pie.
Yeah.
Do you see that? And if so, where does it come from?
I'm really not sure where it comes from, and maybe we'll go into that a little bit later. But to me, the frustrating part is, say I'm in my latter 60s, but the period I grew up in as a teenager, go back 50 years, it was all about growing the pie. It was aspiration, grow the pie for everyone. And to me, it's I think it's a significant backward step if the logic is we've got a set pie and go back historically, like Australia's been one of the wealthiest countries in the world, and now unfortunately. Now, we've had stagnant productivity for a long period of time, and now people are talking about, hey, we've only got so much pie. And frustratingly, and I'm sure we'll talk about it, is the government is bringing in policies to make sure that pie doesn't keep growing.
Yeah, we hear our political leaders, even Treasury officials, talking about fairness and distribution and not so much about productivity and growth. Have you noticed a shift just in recent years?
Well, the most bizarre thing from my perspective is, nearly a year ago, we had this economic round table and, driven by, the Treasurer, Jim Chalmers, I think he was talking about driving it, and then I think Anthony Albanese, was talking about driving it. But effectively, the focus there was productivity. That was the number one focus of productivity. And then not even a year later, they bring in a tax that effectively cripples or destroys productivity.
And I recall reading that when they brought in these tax changes, that Treasury didn't model the impact that it might have, these new rules might have on productivity. How is that possible?
To me, it's unbelievable they've actually brought this tax in. The tax on capital gains, but it's on all capital gains.
Yeah.
Everyone assumed it was going to be a tax on capital gain of housing.
Yeah, which is not unreasonable.
Yeah, if you have an inability of how do you control a market, it's either supply or demand.
Right.
If you can't cut the red tape to increase the supply, then cut the demand.
Yeah, right. Yeah.
And that's what they did. We all know if you increase taxes, then you get less demand. So we understand that from a housing perspective. Then from a business perspective, if you want to have less businesses, less business investment, the lifeblood of Australians, which are the 2.7 million small business owners that employ 5 million people, then why increase the tax on businesses so you have less businesses, less tax, less aspiration, less ambition? Like, to me, it's just so illogical. And that's what concerns me is this purely ideological?
Or is it incompetence?
Gross. Like, is it gross incompetence? I call it economic vandalism in terms of what they're doing. Like, they're not putting us back 10 years or 20 years. They're putting Australia back, 50 years, or even 300 years before Cook arrived. To me, it's crazy.
And, I've spoken to Derek Francis about this, a former Treasury Parliamentary Budget Office official, and he's explained that what we're going to be left with is the highest CGT, capital gains tax in the world, and it punishes the indexation method, which sounds complicated, and it is complicated, to be frank, is going to punish investment in riskier businesses.
Yes.
So what will it do to the Australian economy if we're disincentivised from investing in risky businesses and we're incentivised to just put our money into Coles or Woolworths?
Yes. I mean, the impact on the Australian economy is multifactorial. And you asked the question earlier about what modelling did Treasury do? And unfortunately, Treasury tends not to do the second and third order effects.
Right.
And even I've listened to your interview with Derek, and he quite clearly articulates, the error that they've made in terms of assuming the 7.7 million Australians that own shares outside their super fund, and Treasury have assumed they all own one share.
Yeah. And I think they've undercounted how many young people own shares.
100%, exactly. And that information's come out. But back on, sorry, what was your actually question?
The disincentivising investment in risky high-growth companies.
Yes. Unfortunately, as we've seen with housing in Australia, you increase the tax, then you get less demand.
Yeah.
So all Australian companies, you increase the tax, you get less. You increase the tax to the highest capital gains tax in the world, then you guarantee that you're going to get less businesses. But in terms of the nuances in there, if people have patient capital, and what do you need? Effectively, capital is the oxygen for businesses. So you want long-term patient capital that's prepared to take high risks. Then you have those companies, the CSLs or the Atlassians or the Canvas or the more recently, it'll be the Firmuses, where people are prepared to take a long-term view, take high risk and potentially get the high return. But because of how they've structured the tax, it actually disincentivises people to have significant growth assets. So effectively growth has become a dirty word. So effectively investors will be looking for growth probably in line with inflation. So then they don't pay any tax.
Right.
And then the rest of their return, if they're looking at getting 10% return a year, the old days, because you'd want that 10% to be in capital gain, but now you'd want 3% to be in capital gain and the other 7% to be as a fully franked dividend. Right. So effectively, it's the large mature companies that can grow at a slow rate but have a big cash flows that can pay out high fully franked dividends.
And it doesn't make sense to me that you'd want that to incentivise that structurally if your concern is equity. If your concern is equity, wouldn't you want young people, who have invented new technologies, wouldn't you want them to be able to start their startups and get ahead and have an exit? And for the young employees working in these companies who defer salaries and only get paid with equity, wouldn't you want them to have a go and encourage people to do that?
100%. Like Australia, in terms of younger people and technology, and we all see what's happening in the world with AI, etc., we have been, go back 20 or 30 years ago, we were miles behind the rest of the world, Silicon Valley, etc. And it's only been, the likes of the Atlassians and the Mike Cannon-Brookses and Farquhar, and Canva. We've been able to see those people achieve that on a global basis. Then there's aspiration and then an ambition from young people. Hey, I can do that. Right. And in terms of capital that was prepared to take that risk in Australia, 20 years ago or 30 years ago, there was none.
Yeah.
Now at least we have a pools of capital that can do that. And that's also with self-managed super funds, the growth in that pool of capital. So unfortunately, those young entrepreneurs now that are prepared to do, say 10 years of sweat equity or even young people try to join one of those entities. Now all of a sudden they're going to get taxed double. They're effectively paying close to a 47% tax rate, because what they start with their business is there's virtually no capital they put into it.
Right.
I know the government's talking about carve-outs, but that's just going to make it more complex.
Right.
And to me, the government should do one thing. All they've got to do is one thing, and that's carve out all Australian businesses.
Yeah.
Because that's what we want. We want productivity. We want those aspirational young people to create those exciting companies that Australia will prosper with.
Yeah. So you mentioned before 7.7 million direct shareholders. This is a large group of people, and it's surprising to me that the government is now saying to them, well, you'll have a 30% minimum tax even if, you're a stay-at-home mother or you're a student. Do you think they've misjudged the amount of people that will be affected by these changes?
Well, unfortunately, the government's tried to lie to the Australian people. The government has been gaslighting the Australian people since the budget came in.
Right.
They've tried to focus it all on property, and it's only been people like yourself or people are trying to get their voice out to say, look, this is going to have enormous negative impact on all Australian businesses, which is all about Australians' productivity, which is all about employment, paying taxes, growth. It's going to be really bad. And the government has just denied it. Now, they're just not standing up to, I think, real scrutiny. And whether that's because, the journalists or people aren't holding them to account, I'm not sure, but to me, it's really disappointing that they've tried to pretend that this is all about housing and affordability. In terms of from the affordability perspective, and you talked about young people a minute ago, if I'm a young person, and a lot of young people these days, like when I was growing up, back in the late 70s, early 80s, there was no crypto, we didn't understand markets. The only market I was aware of is the, going betting on the horses, trying to work out odds. Yeah. But young people these days, they are focused, if they're trying to save for a deposit, they're probably investing in ETFs.
Exactly.
But now, if the same young person is doing that today, with the new tax, it'll take them nearly an extra 4 years to save for that same deposit, because of the doubling of the tax in real terms on the capital gain of their investments.
Yeah, I mean, that's what surprised me as well. So a friend of mine a few years ago showed me how to buy shares or ETFs on my phone on an app, and I thought, wow, this is great. And so there's a whole lot of young people who have been passively investing and who have never actually had a capital gain. They've just been putting little bits of their salary into these apps and watching it grow in the hopes that one day they'll be able to afford a house.
Yes.
And so I think it's been a rude shock to a lot of people who have been saving up in that way. I'm curious as to how Treasury got it so wrong when they estimated that only 1 in 10 young people own shares. I guess we just don't know how they got that estimate.
They misinterpreted the data. With the data, it included various other distributions, which came from if you're owning international shares. Right. And to me, the interesting thing about young people these days, they're a lot more globally focused than probably I was when I was growing up, and they're more likely to have shares in Amazon or Apple or et cetera, a global ETF. So the Treasury was just, to me, it's unbelievable they could do that.
And they can't acknowledge the error in public, even though they work for the public.
I know, it is quite bizarre. And to me, the sad part is the answer to the right way forward is, okay, leave the capital gains tax on housing. Yeah. And if you want to if you can't increase supply, reduce demand. Remove the capital gains tax on Australian businesses.
Right.
And we actually put a submission into one of the Senate inquiries and said, whatever you reduce the benefit for housing, increase that, so have it tax neutral, increase that fee for Australians wanting to start their own business. Yeah. Because that's what we need. And if we want a prosperous, growing economy, That's what we need to do.
Sometimes it seems like it's difficult to explain the benefits of productivity. Is it because we've had such lackluster productivity growth over the past 10 years or so? Because we're not experiencing it, we can't see the benefits? Do you think that's what's happening?
Over the last decade, possibly. And to me, I empathise with younger people today in terms of, say you're working, inflation's 3%, say your wage is growing at 3% per annum, but if you don't buy a house today, next year, say the house goes up by 8%, so you're 5% worse off. And then you don't buy it for 2 years, it's 5% multiplied by 5% worse off. And so how can myself as an employee potentially get my wage to grow at a higher rate than that inflation? And it's in productivity. Because if you were my employer and I was doing, I was producing a lot more, you would pay me more.
Right.
So that's how you solve, that's the solution. Unfortunately, the government isn't doing that. Unfortunately, the government's doing the reverse.
There are some industries where it's difficult to increase productivity. For example, if I have a nanny, I can't buy her any tools that help her look after more babies. It's a one-on-one type of arrangement. And so there are industries that are growing, healthcare, aged care, where it's hard to see how we can improve productivity. And they're becoming more and more dominant in the economy, whereas those industries that are actually productive and are increasing their productivity are sort of the number of employees they have is shrinking.
Yes.
So I do sympathise with policymakers in that it is a difficult challenge to raise productivity given an ageing population and the fact that some industries are just resistant.
Yeah, I agree with that. And unfortunately, there's X amount of people that work for the public service and that, it keeps increasing. So, in terms of getting productivity there, you don't. I accept all that.
Yeah.
The fact is you don't, with all that to one side, you don't, if you're a government, you don't bring in a tax to discourage people from starting businesses which employ Australians, which give Australians opportunities, and those Australians, pay tax in Australia, and those businesses pay tax in Australia.
Is there something about superannuation here? Because talking to friends, you'll hear the phrase that the only way we can really invest now is through our super. Is there a conflict of interest here?
Well, to me, this is the frustrating thing: is it's actually encouraging you to invest the wrong way.
Right.
I was talking to a 32-year-old young lady, just been married, just immigrated from America, has got an Australian husband, and talking about how to get ahead. I said, your principal place of residence, because at the moment it's tax-free. I think eventually it'll be taxed. Well, they're taxing everything, so I assume if Labor is still in government, it'll eventually be taxed. And then the other area, is superannuation. And I said, and she said, I just haven't got enough money. Unfortunately, she was a person buying ETFs, trying to get a deposit. Now she's got to wait an extra 4 years to get a deposit to buy her principal place of residence. And even though the price has come down, it's going to take her an extra period of time. And I said, the next one is superannuation, particularly if you've got less than $3 million in superannuation. That's really where the money should go. And she said, well, how can I put money in superannuation when I don't trust the government? And she said, because I won't get access to that money for 30 plus years. So what are they going to do to it by then? And unfortunately, I think, by, the current government lying before the last election about, not bringing in, capital gains and negative gearing, for, young Australians, they've sort of put them off taking that risk, even though from a, that's your lowest tax rate. Is in superannuation. That's your lowest capital gains tax rate. So what it's doing, anyone who's got money in superannuation, if you've got if you're managing the money yourself, then in theory you should take the highest risk possible in there because you're paying the lowest capital gains tax. You should have low capital growth assets in your own name with high fully franked or high yields. And in your superannuation, you should be taking as much risk as you can. Now, how bizarre is that? The pool of capital that should be good for you for the long term.
Yeah, you shouldn't be taking too many risks with it.
Well, but that's the incentive. It's the lowest capital gains tax in Australia.
Yeah.
It's even if you have more than $10 million, it's only 26.
This will lead to inefficient allocation of capital.
Of course.
So,
grossly inefficient.
If we see a new company that looks promising, we want to be able to quickly invest in that, and if it goes bust, then quickly. But this is going to incentivize people not to sell as well and just hang on.
Yeah, 100%. And the other really frustrating thing is it's going to change companies' behaviours.
Yeah.
Now you look at it from a company's perspective. So what it'll do, it'll actually encourage companies to
stay small.
Well, stay small, but if they do make money, to pay out 100% of their earnings to the investor. Don't invest in your staff. Don't invest in new machinery or anything, because it disincentivises you to do that. And let me I'll just quickly take you through the maths.
Sure.
Oh, actually, another thing it'll do before that, if you're a young person. These are all these behaviours that Treasury hasn't modelled. It'll change your behaviour because currently it's a minimum of 30% tax on capital gains, adjusted for inflation. If you're a young person and you're not earning more than $225,000, and $225,000 is when you pay on average more than 30% tax.
Right. Yeah.
So up until then, you're paying less than 30% tax on average. If you earn less than that, it's not in your interest to buy a share and own it for more than a year, because then it's capital gain and you've got to pay at least 30% on that.
Right.
It's in your interest to become a trader.
Okay.
To buy something and sell it quickly, it's giving you all the wrong, because then it would be income for you. If you're a trader for tax purposes, you put it on your income.
Oh, I see.
And then you're paying less than 30%.
Yeah, got it.
So first of all, young people all should become traders.
Yeah, gamblers in effect.
100%. If you're a student, become, and if you're retired, become a gambler. But then back for companies, say if you're the zero taxpayer, if the company earns whatever it does, and $100 of its earnings, it's a 30% taxpayer, so the company is, so it pays $30 tax. Of the additional $70, what it should do, if it pays it out to the student, the zero taxpayer, as a fully franked dividend, that student gets a dividend imputation, so they get that $30 back. Right. So that student gets the $100, pays no tax. Yeah. If that student or retiree, the company leaves the $70 in the company, so it's paid $30 tax, $70 left in the company, and so the student the value of the company goes up by $70, so it's a capital gain, and the student sells it, they pay another 30% tax on that $70. So effectively the student, if they got a fully franked dividend, they're getting it tax-free, or the pensioner, they're paying 51% tax. For the 47% taxpayer, it's 62.9%. So it's not in any company's interest to maintain any money and reinvest in the business.
Wow.
So it's in every company's interest to pay out 100% of their earnings to their investors. Like, it is just all the behaviours, and all these haven't been modelled.
So these changes are really anti-productivity,
anti-investment, pro-gambling.
But this will undermine confidence and shrink the economy.
100%.
Which then results in less tax revenue.
100%. Yep.
So,
less tax revenue, yep.
I mean, I don't think it's hard for me to accept that this is all driven by ideology. It sounds to me like it's gross incompetence on behalf of the government.
Well, it's one or the other. It's either gross incompetence or ideology to me, or they are just grossly stupid. Yeah. Like, to me, it is naive. It's economics. It's first-year economics. Now, unfortunately, I said that to someone recently, and they said, well, a treasurer hasn't done first-year economics. He didn't do an economics degree.
Chalmers has a political science PhD.
Yes.
Yeah, right.
So to me, it's but I can't believe, I can't believe they're that stupid.
So it sounds like Chalmers and Albanese have said this is the result we want to announce this policy, for younger Australians, with the goal of intergenerational equity. And then Treasury have looked at, well, we need this amount of revenue to fill our budget black hole.
Yes.
And so they've engineered it backwards rather than creating policy through the proper process where they've gone out and consulted with stakeholders, all of the different people who would be affected.
Yes.
And that's during that consultation period is when these issues come to light because, no one, even a bureaucracy as big as Treasury, they can't.
Unintended consequences.
Yeah, I mean, they've got blind spots and you have to go out to stakeholders, and it's people like you and others who will identify these potential landmines.
Yes.
But they haven't done that for political reasons.
Yes, because they didn't want to alert everyone before that there's going to be a change. I mean, to me, you're really giving them the benefit of the doubt. And one of the positive things is Treasury did come out, I think, a week or two after the budget and said that we increased it because we needed more tax. Yeah. It was effectively a tax grab where, to me, there's either your scenario where, okay, we're only going to do it for property, and then Treasury convinced them to do it for everything because they needed the tax, and then they tried to spin it as they were, or it's the other way where they philosophically they always wanted, ideologically they always wanted to do that, and then they had to try to, like, how can we gaslight most of Australia or a significant portion of Australia so they'll still vote for us? And to me, I think the interesting part is, we'll be working over the next couple of years to try to get everyone to understand this. We've got a sort of a grassroots strategy because it is complex. Yeah. And the interesting thing is that the people that are concerned about the new capital gains, I think a survey that was done in the last couple of weeks was saying it's increased from 32% to 38%. And as people, over the next year, because it comes in on the 1st of July 27, as they sit down with their financial planner, as they hear, these podcasts, as they work out, the negative consequences.
When people have to do their tax returns.
Well, unfortunately, they're not going to do the tax returns for that year till the year after. The tough thing is, like, I was sitting down having coffee with a small business person this morning, start up their own small business, and was saying, I've got to get my business valued at June next year. And so, like, there's 2.7 million small businesses. Yeah. So, what does it cost? I mean, you've probably got to get your business valued.
Yeah, I will.
So we're in the old regime. And to me, the bizarre thing is, like, people are saying, why are you being so outspoken about this? It's because it is just, whether it's economic suicide or economic vandalism, but it's bad. It's bad for the younger people, the younger generation. I'm grandfathered. Right. So like, I'm looked after. And it actually, the structure, what we do is, as fund managers, all our products are high-yielding products. Yeah. So it's actually benefits it for us. We just raised $170 million for a new fund thanks to Jim Chalmers and Anthony Albanese last week. So to me, we're beneficiaries of it. But we've got 130,000 investors, a lot of small mum and dad investors and young people, and it's important that we stand up for them. Yeah.
I'm surprised that the business community hasn't been more outspoken. You're a high-profile critic, of course, but why aren't there more Geoff Wilsons?
Unfortunately, look at all the listed companies. They're all owned by the industry funds and the union funds. Okay. So to me, and also, why put your head up and take the risk? You're running against the government. Yeah. And people are scared, to take that risk. But in my industry, whenever I run into someone else, they say, keep going, please, keep going. And so, so every public company has a conflict. You look at the four big banks. Yeah. You could argue there should be a bank tax. So they're not going to say a word. Right. So they're big employers, and unfortunately, most of all the other large listed companies are owned by the superannuation funds, the industry and the union fund.
As I have said in the past, it's hard enough to start a business in Australia. For example, I've got my business here, but most of my customers are located overseas. And it'd be very easy. Well, theoretically, it could be easy for me to just hop on a plane and move over to the United States.
Yes.
I've got more customers there than I do have here in Australia.
Yes.
And it seems to me that, people in my position, lots of small business owners or startup entrepreneurs will just do that. They'll hop on a plane either to Singapore, to New Zealand or the United States because, we've already got a small market. We've already got significant incumbent businesses who dominate certain industries. And now, if we're going to be punished with this punitive tax, then what is the reason for staying?
Well, I mean, it's a fair point. It stops the aspiration.
Yeah.
So, why does a young person aspires to be something? It stops the aspiration and ambition. And you're 100% correct. And we're already seeing, there was a few posts the other week, I noticed, I think it was on LinkedIn or X, that a couple of Australian companies, they've decided, okay, we're going to position ourselves in the US.
Yeah.
And also it works the other way. There are some incredibly intelligent, highly intelligent Australians that have left Australia, moved overseas and want to come back. And I was sitting, a few weeks ago, I was sitting down with a founder of a technology business in Australia. Before the budget, he'd convinced this top quality Australian to come back from Singapore and run his business or the technology business in Australia. And he was going to give him a good salary plus 5% of the company to incentivise him. Well, of course, the budget came in. Now he's got to give him 10% of the company.
Right.
Because the tax has doubled on capital gains. He said, I can't employ him. I can't afford to.
Yeah.
I can't give everyone double.
Yeah.
There's only 100% of the company. I can't just give everyone double.
And will it disincentivise investors from investing in these new startups, potential investors from overseas who look at,
100%, because we had a vibrant sort of investment community here in Australia. Any small company, small listed company, it's actually just made the cost of your capital go up.
Right.
Because all the money will go to the bigger companies. And in terms of getting, for the small startups, to get people to invest in Australia, it was tough enough at the start and it'll be tougher. I mean, in terms of those, the brain drain or the missing out on highly smart intellectual people or good business people or good entrepreneurial people or any people. I think the CFO of Canva from the US came to Australia. He said if this capital gains tax was in when I was offered the job, he would have not taken the job. So trying to get those highly intelligent people from overseas to come and work in Australia for a period of time, you just shut the gate on that. So it will be this little island with that all the effectively the brain drain will be significant, and there won't be any.
And it's not easy to recover from this. I've been reading about the history of the UK, and I was surprised to learn that they had an effective 98% tax rate in the 1970s, and they had extreme brain drain. So scientists, artists, all sorts of talented people left. And that's not the only reason why their economy is moribund today. But it seems to me like if you vandalize your economy that badly, it can take generations to recover.
Generations and generations. And unfortunately, we are heading in that direction.
Yeah.
And the reason I say that is, we've gone through all the negative impacts of capital gains on Australian businesses and young Australians. Also, unfortunately, the government is changing the tax on trusts. So effectively, they're bringing in a double taxation on money that's in trusts. So we've got the franking credit, the dividend imputation system, and now we're going to have the trusts with a double taxation on trusts. If Labor win the next election, I'm sure they'll do what Paul Keating wrote in a letter in 2013. He said Treasury try to get rid of dividend imputation or franking every 7 years. And that'll be the end of dividend imputation franking. And then you'll see a real problem in terms of exactly what happened in the UK. The UK had a similar system to our dividend imputation. It was called advanced corporation tax. They got rid of it in 1999. What that meant was there was no incentive for the people in the UK to invest in UK companies. See, because of the removal of double taxation, all Australians like investing in Australian companies listed on the Australian stock market, or their superannuation invests in those companies.
Yeah.
The UK ownership of UK companies fell from 40% in 2000 to, I think, 6% now.
Oh, geez.
The exact same will happen to Australia. If you think it's bad now,
yeah. Well, it becomes a feedback loop. If you're harming the economy, you've got less tax because people are earning less, businesses are earning less, so that reduces your revenue.
Yes.
And so you've got to raise more revenue, so you add more taxes on top of it.
Yes, and like it looks like, that's right, the big debate is, when will the tax on your primary place of residence come in? And I assume what they'll do is they'll say, maybe, the first 5 million is tax-free, and then for 5 million above, there'll be a tax rate. And I suppose it's just a matter of time, because there's nearly $1 trillion of debt. It's got to be paid back somehow, that debt. And so the tax when you die, like there'll be, it's just a matter of time before that.
And we can't, there are all of these other headwinds, the ageing population, growing, the NDIS, for example, keeps growing. So there are all of these other headwinds that make the economy look like it's going to be in bad shape for some time.
You just challenge.
So how do we unwind these changes to the capital gains tax? Can the legislation be repealed, or can there be an amendment, or do we have to wait for the government to change?
I mean, the good thing is they are looking at carve-outs. And to me, effectively every Australian should write to their politicians and clearly articulate that they want the capital gains tax on businesses removed. And in theory, Australian businesses could be carved out.
Right.
So, I mean, I'd say that's a long shot. Labor tend not to, once it's been legislated, they tend not to re-legislate. So it's really got to be a change in government.
Now, the opposition are opposed to these CGT changes, but they're also opposed to the changes on negative gearing and the capital gains tax on housing.
Yes.
Does that make it more difficult for the business community to argue its case, or not really?
Not really. I don't think so. And I mean, you got that's the coalition, and then One Nation. I think One Nation are talking about a 20% capital gains tax, a flat capital gains tax, instead of sort of 40% real. The highest in the world. At 20%. So to me, I assume they're doing that so people can look and there's an alternative.
Right.
To me, the scary thing is with property. Unfortunately, it looks in hindsight that they've just pulled too many levers.
Right.
In terms of reducing the property price, because the negative wealth effect that'll have occurring while the economy is fragile, while interest rates have been increasing, while inflation is still high. To me, there could be some real stress in the property market.
And could this all lead to a recession?
Yeah, it could. I mean, you could argue that on a per capita recession, because we've had significant immigration, then we're seeing the absolute numbers grow, but on a per head of population, you could we've been in recession. So to me, if immigration reduces, and once it's clear this tax is definitely coming in on Australian businesses, then it's going to be a tough period.
Well, is there anything that is is there any optimism that we can take from all of this conversation? Not really, is there?
Not really. No, to me, the frustrating thing is, again, I don't know if you noticed that, but the Treasurer, Jim Chalmers, was crowing about the number of companies that were registered in June this year. I think it was 43,000. It was a record number of company structures were set up. Now, the frustrating thing is he was saying, oh, well, how well is the economy going? The unfortunate thing is only half of them, I think, were registered as real operating businesses. The other half were registered to reduce tax.
Oh, really? Okay.
Well, because trusts are going to be at least
right.
30% tax, and a company, if you earn less than $50 million, only 25% tax.
Yeah, yeah.
I mean, to me, the great thing about I think Australians are they're very resilient, and unfortunately, this is a period that everyone will have to be resilient. Good ideas and good growth companies can still perform.
Yeah.
The frustrating thing is the current government is just going to make it really, really difficult for good Australian companies, A, to be created and B, to perform.
Are you encouraged by the campaign against these changes? Do you see that there's lots of ordinary people who are concerned and
100%? Yeah,
organised?
Yeah, to me, is the government hopes that it'll go away and it'll just get stronger and stronger as we move from here. Over the next year to the 1st of July 2027. Yeah. More people will realise the negative impact it's having on them. We've already seen it in the various polls that people are getting more concerned. And what we hope, and we're very vocal about the tax on unrealised gains that was in superannuation, and we spent 2.5 years sort of fighting for sanity there. Or as Jerry Harvey said, I think it was insanity of stupidity of the highest order. Yeah. To me, that was taxing unrealised gains. To me, this is stupidity of the highest order. And what happened is, over that period of time, the government did realise that we did some research and showed they're going to lose 29 seats. And I think everyone is focused on their own job. Yeah. All of a sudden, they realised a lot of people are going to lose their jobs. That's why sort of a grassroots campaign, as people get to understand the negative impact that's going to have on their livelihood, on their children's livelihood. I remember, I was talking to two mothers. I was waiting to pay a bill, and I was just saying, "Look, what did you think about the budget?" And they said, "What budget?" And I said, "Oh, the federal budget." A couple of months ago, and they said, "I just can't believe." I think they're in their mid-40s. They said, "I can't believe how this is going to take away the opportunity for my children." And that is powerful to me. If more people, they've just got to communicate to the politicians that they're going to lose their jobs if they go through with this, and then there will be change.
Yeah, well, it's not a very positive time in Australia with these changes coming in, but I am, like you, I am optimistic about the resilience of Australians, and I do think that once people fill out their first tax return and realise how complicated it is to record any kind of capital gain, I think the shock will definitely hit home.
Yeah, or make them traders.
Yes,
which is no good for long-term capital deepening, is it?
I just hope that there's some accountability inside the federal bureaucracy for the bad advice that has been given to the government. I suppose the buck stops with the government, though.
Well, it does. It's not really Treasury. I think Treasury's job is to raise as much capital raise as much money as possible, right. And that's why sort of Paul Keating, I think he would say privately that in terms of introducing dividend imputation or reducing double taxation back when he did, and bringing in franking, it was him fighting against Treasury. Yeah, and that's why I think he wrote that piece that I referred to in 2013, said every 7 years they try to reverse it because they don't realise the benefit of having Australians investing in Australian businesses. Which, I mean, the great thing about franking and dividend imputation, it reduces the cost of capital for Australian businesses. Yeah. But unfortunately, Treasury's focus, I think, is not looking at the unintended consequences, not looking at the third and fourth derivative of something, which is, unfortunately, from your perspective, is a failing.
Yeah. And like one of my prior guests, Parnell McGuinness, said she would introduce a policy where if you're going to work in the federal bureaucracy, you need at least 1 year of work experience in the private sector. So
at least 1 year, geez. You'd hope it would be at least a decade, wouldn't you?
Yeah. Well, thanks so much for joining me today, Geoff. It's been eye-opening talking to you, and I'm not encouraged about the government's changes, but I am encouraged that there is such a robust campaign against them. So thanks for joining me today.
Thank you very much.